Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is Yahoo Finance senior reporter Allie Canal, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're going to be talking about this bull market that will not quit, alongside the investors who keep buying the dip. Our phrase of the day is price discovery. It's how markets work at their core. But what happens under stress when prediction markets, tokenization, and 24/6 trading introduce their own set of new variables? And on today's Market Show and Tell, we take a deep dive into short interest. Can anyone say short squeeze? And this episode is brought to you by the number 27%. That is the stock market return outside of the U.S. this year alone. We look at some international markets that are trouncing American stocks in 2025. And today we're welcoming back Caleb Silver, who is editor-in-chief of Investopedia, also the chief business editor at People Inc. He is an Emmy-nominated business journalist who spent about 3 decades translating markets for everyday investors. And this is his 5th appearance on Stocks in Translation. Caleb, welcome to the Five Timers Club.
Number 5.
Good to be back. Yes. Why don't we start just by telling us what you think of the current markets right now?
Yeah, a little choppy right now, a little windy out there, a little choppy in the stock market right now. Is it to be expected? These are the beginning of the 6 best months of the year for the stock market, but we've had a pretty good run. We've had a pretty good run off those April 2nd or 3rd lows. Stock market was up some 30%. Lots of drum beats around overvaluation, bubbles, fragility, too much weight in one sector of the market. We've heard it all, and it's not crazy to see a little bit of a sell-off here, but a nice little healthy sector rotation. If you look at what's happening inside the market, sector rotation, of course, the lifeblood of the markets.
So why now? Because we've been talking about market bubbles and all these risks to the stock market for quite some time, yet stocks just kept powering higher. Why are we seeing this sell-off at this point?
Well, I think expectations have been just so high, and companies have been delivering amazing results. Profit growth has been great. If you look at the numbers just for this quarter, profit growth is up some 13% plus, and if you look at the tech companies, up more than that. So expectations are super high. If you're not blowing out those expectations, there's a little bit of a sell-off here, but don't forget, investors have had a great run riding about the same 10 to 12 stocks for the past 2 to 3 years, really since this bull market began in late October of 2022. A little selling here, end of year, maybe rotating out into different sectors of the market, not crazy. Also, there might be some catch-up play from those global fund managers that were bearish for so long, so we might see this balance out over time.
All right, well, that all relates to our phrase of the day, price discovery. It's a process where changing supply and demand pushes the price of a stock or asset toward the market's best current estimate of its value. New information changes what buyers are willing to pay and what sellers are willing to accept, causing prices to move as the crowd updates its view of value. So, Caleb, when we talk about price discovery, how do you think about that, especially within the context of this current market?
Yeah, well, usually we look at things like the equity risk premium, right? Where are treasury bonds trading right now? What's my risk or what's my potential payout if I take a risk with higher risk assets like stocks?
Sure.
Fact is, for the first time in a long time, we see the bond market rallying. I was looking at the Bloomberg Ag Index. That's a sort of a compilation of some corporate bonds and government bonds and mortgage-backed securities. That is up 6.5% plus so far this year. That's been in a bear market for years.
Which means yields are falling.
Yeah, yields are falling, which is good for people that hold those bonds in terms of price. But you rarely see that happen at the same time. You see the stock market kind of having these record highs, even though we've been off that for a couple of weeks. So price discovery is pretty hard these days, especially when you have companies that are 5 trillion in market cap, like Nvidia's of the world, or the Palantirs of the world, that have really super high valuations, trading on good profit growth, but at the same time, the valuations are back to where we were back in the late 90s, 1990s nosebleed days. So it's hard to have discovery when you have these outsized gains by 10 to 12, I said, big companies.
I'd love to get your take on what some of the browsers of Investopedia.com are looking at right now, because just like Yahoo Finance, we serve a retail audience, and sometimes just what people are looking at can give you a lot of information about what might happen in the market. So what is that saying?
Yeah, I was just digging into this recently. I like looking at it every day, but we like to look at it over a period of time, especially after a market-moving event. So you had the government shutdown.
Sure.
People were obviously looking at the impact of that. How was, which one was the longest? How did it affect the economy? How did it affect the stock market? market. But beyond that, as yields fall, as the Fed is probably going to lower rates over the next year, if you believe the dot plot, you're seeing more and more people, and you could tell just by age group, looking for ways to get out of money market funds, get out of high yield savings accounts as those yields come down below 4% or so, looking into investing in ETFs. And if you look at ETF inflows this year, B of A Research had a good piece on that last week, record inflows into ETFs, equity ETFs, record inflows into tech right now. So a lot of our investors are looking at the same thing. Where should I put my money if I want to continue to ride this bull market, and where's a little bit safer of a place if I don't want to buy individual equities? So they're looking at the strongest ETFs. They're looking at what's inside of them, how they're constructed right now, and they're also looking also for weird omens like the Hindenburg omen.
Oh, my favorite. That'll grab some headlines whenever
absolutely.
It fires off 5 times in a row.
Yeah, the Hindenburg omen, obviously, when you have a bunch of different technical indicators flashing warning signs when the market trades below its 50-day moving average, and you have a big split between advancers and decliners. They're looking at that, and they're always looking, some of them, for opportunistic ways to play the market.
And when we talk about retail investors, there's been this buy the dip mentality that we've seen consistently. But at the same time, I am hearing from more strategists that there is some AI fatigue and that retail trading has slowed a bit compared to where we are. What's your thoughts on the retail trader at this point in time?
Yeah, aggressive and bullish pretty much all year. We survey our readers every 2 months. They're cautiously optimistic. They've been that way for a while because they've been sitting on gains. April shook them a little bit, shook all of us a little bit, but they're still cautiously optimistic. And if you look at flows, and I track this from retail investors investing outside of their defined contribution plans, outside the 401ks.
Interesting split there, yeah.
5 months in a row of buying. Continued buying and buying the same stocks that they hold, buy, protect, and love.
Well, guess what? They've worked.
Yes,
yeah.
They keep working. So if you look at the top buys, just over the last few weeks, I was checking out Fidelity Screener there. You had NVIDIA on that list. You even had Tesla on that list, always a highly traded stock. You had Palantir, Microsoft, Meta on that list as well. When you look at what they're selling, they were selling some healthcare, they were selling some chip stocks, but in general, the trend has been buying. That's why you have those record inflows into equity ETFs this year.
Yeah, interesting to note healthcare. Maybe we'll swing back to that later in the show. But now it is time for market show and tell. Today we are tackling short interest, which is the number of shares investors have borrowed and sold, betting that a stock is going to fall, shown as a percentage of the shares that are available to trade. And when that percentage is high, it means a lot of people are betting on a stock's decline. And Caleb, you're bringing in Jack in the Box, ticker is JACK, as an example, which has investors shorting about 35% of its shares. That's the short interest. So tell us how you use this data, which is also kind of on a delayed basis.
Yeah, first of all, A+ on the explainer.
Thank you.
Are you? Investopedia, A+ for you there. But also,
I borrowed heavily from Investopedia.
Ding, you guys have a great short interest screener on Yahoo as well, where I look some of this stuff up, where it is a little bit delayed, but you're seeing where the biggest bets are against a single equity or an index in the case of the S&P 500 or the NASDAQ. So we want to see, when you look at short interest, you want to look at how many shares are being shorted relative to the overall share count, right? You want to look at what they call the short interest ratio, how many days to cover.
Right.
A lot of those shorts were called out, and the float, which, as you mentioned, close to 35%. Guess what? Jack in the Box shares down 64% so far this year. So that's a stock that investors have been betting against, which makes me sad because my grandfather used to take me to Jack in the Box when we were running errands around Southern California back in the 70s. So sad to see that happen, but it's a good way to look at whether or not investors are bullish or bearish on a stock outside of the normal research you do. If you looked into the fundamentals of Jack in the Box, not great right now either, but the fact that there's so much pessimism around it, it's a good flag for retail investors whenever they're considering buying a single stock.
Is there a way to look at the short interest in a stock and kind of determine whether or not that's setting up for a short squeeze?
Yeah, I think the more you see that short interest pile up, especially in a short period of time, and then you look at who actually owns the stock, if it's heavily owned by institutions or insiders.
2021.
There you go. Yeah. Can I bring you back a few years to 2021?
Yep,
that
the
was the
GameStop
game,
phenomenon.
right? The more the short interest, the more that big institutions and hedge funds were betting against these stocks, the more that retail investors, especially in meme stock land, were squeezing these stocks by buying them and encouraging others to buy them, setting the price higher, and that makes the people that owned it, that were shorting it, have to pay up those shares that they borrowed. It's pretty painful when you have a short position and the stock gets squeezed and squeezed higher, and you own it, you end up losing a lot more than you bet going in.
Caleb, I want to ask you kind of a bigger picture question outside of the short interest conversation here, but using Jack as an example, also Chipotle, also Lululemon, we have a bunch of retail names, and it seems to be a tale of haves and have-nots. Have-nots. Does any of the basket of losers concern you right now, or is that just normal market wear and tear and rotation?
Yeah, I think it's a little bit of that, but it's also some of these stocks may have lost sort of that momentum. And right now, it's all about momentum. There's a few metrics that really matter right now in the stock market. Price being one of them, but the other one that's super important is revenue per employee. I think we've talked about it before, maybe on this show, but I think that's the single most important metric that big investors are focused on. How much are you squeezing out of your workforce? And guess which company has the highest revenue per employee in the stock market? You first.
Oh, gosh.
Microsoft?
Yeah, I would say Apple.
Second.
Okay.
NVIDIA.
NVIDIA.
Yeah.
About
Okay.
$3 million.
I thought that was too obvious.
Right,
I was
about
like, trick
$3 million
question.
per
plus-
employee. They squeeze a lot, and they make an actual product. You'd think some of these other software companies that don't have to produce anything
Sure.
would have that. Apple, again, makes a product but gets a lot of revenue out of its employees. So that's a good signal when you're looking especially at AI and this demand for gross margin improvement. If you're using AI or if you're investing so much, how much are you getting out of it and how much are you getting out of your workforce? Not a great sign for the workforce either.
All right, well, hold that thought. We need to take a short break. But coming up, we're talking international stock markets trouncing the U.S. and a runway showdown that puts price discovery right in the crosshairs of new trading technology. Stay tuned. This episode is brought to you by the number 27%. That's how much the MSCI All Country World Index, basically global stocks outside of the U.S., is up this year. Meanwhile, the U.S.-based S&P 500 has climbed a very respectable 15%, but many countries are far and above those two markets. We have 70% gains in Korea, 40% in Spain, over 30% in Hong Kong and Brazil. And Caleb, it's so interesting because I was just talking about this with my little brother, and he said I'm not diversified enough outside of the U.S. Is it too late, though, considering some of these valuations?
Well, I think a lot of people are now questioning the emerging markets trade and how strong some of these markets have been all year. What's crazy is that these markets have been strong all year despite tariffs.
Yeah.
Now, China is also outperforming the U.S. despite all the threats of tariffs. But even if you look at countries like Poland and Greece, they are trouncing the United States. Not big stock markets, not very liquid, and don't really hold a lot of growth stocks, but they've sort of been immune to a lot of the political and trade and tariff noise that's been out there. Is it too late? It's never too late, but now you got to be selective because we've had really good runs in a lot of these countries. Now, what do these countries depend on? They depend on good trade and good demand. A lot of them that export to the United States. South Korea is top of that list. So it depends on good relations. And if the good relations are good and there's more trade deals that make it beneficial for the companies, let's say a Hyundai or other countries inside South Korea, it could be okay to stick with it. It is very rare, though, to see international markets outperform the U.S. for an extended period of time. It's very much a U.S. stock market around the world. No, not being nationalistic here. It's just the biggest market and the most liquid in the world. So this is very rare, and it doesn't last forever. I wouldn't say it's too late, but I wouldn't go all in or even load up half of the boat with international stocks at this point.
So considering you're just saying that longer term, the U.S. usually always outperforms international markets, should you then be just diversified within the U.S. and not really be looking outside too much?
Well, back in the day, we were a globalized economy, and we may still be a globalized economy, despite what you might hear from Washington right now. So it's always good to have a little international exposure, and you never know when you're going to get one of these markets breaking out. But you don't have to go out and look at the map and go put pins in them and try to pick them individually. Buy the MSCI All World Index. Make it a part of your portfolio. Make emerging markets a part of your portfolio, especially if you think the trade winds, and I mean that literally, are going to be favorable towards these countries going forward. Good time to own some of them inside the portfolio, but I wouldn't go all just U.S. and then half outside the U.S. Make it a piece, not the entire half.
I'm wondering, since we're talking big picture here, if I could get your opinion on gold and some of the precious metals, also the dollar and crypto. What do you see this complex? Where do you see it now?
Yeah, there used to be some sort of a correlation, and the only correlation, let's start with Bitcoin, is that it's a risk asset. It is the epitome of risk asset.
Correlations change a lot with Bitcoin.
Absolutely, they do. And the fact that you even had Bitcoin and gold rallying as much together this year
for a while, sure,
is pretty strange when you think about why Bitcoin was allegedly created. But it just shows you how the investor base in Bitcoin has matured. We still have probably most of it owned by a very small handful of people, but the retail exposure has been broad. Institutions are jumping in. By the end of next year, we're going to have it in our 401ks if we want it. So it still has room to grow, but it has been very much a risk-on, risk-off asset. And the fact that it's had this tremendous plunge over the last few weeks, actually, if you look at Bitcoin, that's nothing crazy. That happens pretty often with Bitcoin.
80% is crazy, but we're not even close to that.
Not even close. So anybody that's been a Bitcoin hodler for a long time
Right.
knows that this is a very small bump in the road. You look at the dollar, that is all trade, right? That is trade and also a belief in the health of the U.S. economy. Now, the most widely held assets in the world are the dollar and the U.S. Treasury. So if you look at the yields on the Treasury and you look at the dollar, and it's still down about 10% or so this year.
It's been that way for a while, yeah.
That tells you that, A, it's part of the tariff policy, and B, there isn't that much confidence in the growth aspect, in the growth prospects for the U.S. economy as seen by the biggest holders of our assets.
Now, I recently talked to some economists who say that the dollar was consistently overvalued and that this correction maybe was needed and we could see that play out over potentially the medium to long term. Do you agree with that, or do you think we're going to see this bounce back in the dollar anytime soon?
I don't disagree with what that person told you, and I also think a lower dollar is actually pretty good for a lot of our companies that do business outside the U.S. So I think that's part of this administration strategy too. I think depressing the dollar one way or the other is actually beneficial, and I don't think that they mind it. So I don't think it's going to be this way forever, and a very strong dollar could make it very tough for a lot of the countries starting to do business or continuing to do business outside this country if tariff negotiations continue to ease a little bit and there's more business to be done country to country. You kind of want the dollar where it is. Look at the profits that the American companies are making these days.
Caleb, you said something towards the beginning that I just wanted to reiterate here, that market rotation is the lifeblood of a bull market. I think it's Ralph Alcampora, CMT, who said that. He's known as the godfather of technical analysis. He's also Jay Wood's uncle. Jay Wood's another regular here, another five-timer, by the way. Where am I going with this? I wanted to talk about healthcare because we've seen healthcare is the number one performing sector this quarter. So we're thinking since October 1st, and also what happened October 1st, that was the very beginning of the shutdown. So I don't know if that's a reaction to it, but what do you think of the rotation that we've seen over the last month and a half or so?
Yeah, well, defense wins playoffs, and when things get a little tense at the end of the game, you want your defense to stand up. Healthcare is a pretty good proxy for that, as are financials, which have also been a relatively strong sector. So there's that, but there's also the fact that prices are going up across the healthcare complex, and I'm talking about healthcare insurance premiums. One way or the other, those are going up next year. Healthcare costs in general are going up next year and beyond. So that's one of the places we've seen a lot of inflation. A lot of that, or some of that, goes to the bottom line of some of the healthcare providers. But it's not as if the growth is going to be that extraordinary where if all of a sudden it looks like there's yet another leg of growth in tech, and then we might find that out when NVIDIA reports results, then you're going to want to be in those aggressive sectors. So you can see that rotation rotate back as soon as there's a feeling that the coast might be a little clearer for tech.
Excellent example. We got to stick with trading here because we've got a markets take on a classic Hollywood Gab show staple. We call it Who Wore It Better. Today's Runway Showdown is all about how prices get set in today's markets. On the right catwalk is the odds maker, strutting in a flashy jacket, phone in hand, checking live yes-no odds like it's a sports book for stocks. On the other side, we have the spreadsheet strategist, gliding down the runway in a tailored suit, arms full of color-coded models for every ticker, as well as earnings printouts. Both are trying to answer the same question. What is this stock really worth right now? The odds maker leans on guts, odds, and momentum. The strategist leans on numbers, patterns, and patience. So in this current market environment, Caleb, who wears it better, the flashy odds maker or the button-up strategist?
Yeah. Well, the odds maker is having a lot of fun right now when you think about all the different ways that you can bet on probability, whether it's in the capital markets or whether it's in sports right now or even politics. You can bet on just about everything right now. And if you look at where the action is and a lot of the speculation, you could say the odds makers are doing a little bit better. And another way to tell is that strategists keep revising their targets.
Oh, yeah. It's been tale as old as time.
Right. And yeah, we get that every year. That's part of the deal. Hey, 2 months ago, I think I'm going to put a new price target on the S&P 500 because I'm feeling a little bit more bullish or bearish or whatever. That happens all the time. So they're constantly moving their targets around. So it's hard to argue that they're doing better. That said, there are a few out out there, and the Ed Yardanis of the world and others who actually stay pretty consistent with their year-end picks. So I don't want to disparage too much, but it is this confluence of things that are happening at the same time. This has been a big year for it. The smashing together of the betting markets, the poly markets of the world. I know Yahoo's done a deal with them. ICE has done a deal with them. CBOE is doing a deal with them. But you also have more people betting on sports, 37 million online sports bettors right now. People doing a lot of day trading, a lot of options trading. This is all slamming together. And younger generations like that quick action. They like to bet on the probability, the coin toss. Hopefully, that is their entranceway into long-term investing, because that's where the real money's made. But it is fun, and if that's what brings them in, come on in.
I was going to ask about that. Like, what are the long-term ramifications of that if you have, sports betting and all these other types of betting platforms emerging? Does that get more people into the market and then drive gains even higher so you have a bigger pool of retail traders?
Yeah, let me roll it back to Robinhood introducing free trading back in the day. Now, that was the instigator to a lot of people jumping into the stock market. Then you had COVID, and you had the roaring kitties of it all, and everybody all of a sudden on Wall Street Bets is an expert.
YouTube, social media.
All of those things coming together has really brought us to this point. And now the fact that you can bet and really bet money on just about everything and tie it together, that's fascinating. Plus, we have the 24/6 markets opening up in Texas. We have the tokenization of just about everything. So picture this. There is Amazon.com, the stock, AMZN, and then there's the tokenized AMZN that trades 24/6.
Maybe with leverage, too, in the future. Who knows?
Talk about price discovery. Well, which stock, where's the real price? Is it on the stock that stops trading at 4 p.m. every day? Not really, but stops trading it every day at 4 p.m.? Or is it in the tokenized version of Amazon that is trading around the clock and can be off 5, 10, 25 percentage points by the time you wake up in the morning?
I think we need to have a separate conversation about a
100%.
potential Minsky moment for all of this the new markets activity that we're seeing here. But we got to wind things down. Had a rip-roaring discussion, not only about price discovery and the nature of it, I learned a lot here, but also short interest. And you don't knock that out, because even though it's a lagging indicator, it can be a powerful tool to predicting market squeezes. And also, we took a look at the international side of trade this year, and a lot of people in the U.S., it might have flown over your head, but there are some markets outside the U.S. that are going gangbusters this year. So don't say that there's no potential for diversification outside the U.S., at least not right now. And on that note, we got to bring it to a close. Be sure you check out all the other episodes of our video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. So be sure to leave a comment, and subscribe wherever you get your podcasts. We'll see you next time on Stocks in Translation.